2025 has been a brutal year for the Indian rupee. The currency has weakened by approximately 4.8% year to date, earning it the dubious distinction of being Asia's worst performing currency. In a dramatic descent that shocked markets, it took less than 15 trading sessions for the currency to cross the 91 rupee to a dollar mark in December, touching record lows along the way. So what's driving this relentless slide? The story is written in billions of dollars flowing out. Foreign portfolio investors withdrew nearly $18 billion from Indian equities on a year-to-date basis. Add to that the spectre of Donald Trump's tariffs on Indian goods, stalled US-India trade negotiations, and you have a perfect storm. Yet, here's the paradox. India's GDP is still growing at a healthy 6 to 7%, forex reserves remain robust, and the current account deficit is manageable. So, why is the rupee bleeding? For India's middle class, this isn't just a number on Bloomberg. It's hitting your kitchen, your children's education plans, and your investment portfolios. In this episode, we break down what this volatility really means for your money and how might the rupee behave in 2026. Listen on. It's Friday, the 26th of December. I'm Anirban Chowdhury. This is the Morning Brief. Hi, Madan. Very warm welcome to the Morning Brief.
Yeah, thanks a lot, Anirban.
So let's start with how do you think the rupee has been behaving? What do you think it has impacted? And then we'll go to some future-looking statements as well.
Okay, so the rupee has been very volatile in the last couple of months. And I think it's all been linked to the trade deal with the US, which hasn't quite materialized. We're, of course, hopeful it will happen in the next couple of months. But as the rupee keeps depreciating, the cost of imports tends to increase. Now, we should remember that everything that we import goes in as a final output or an input for the production of other goods, which really means that at the end of the day, you and I as consumers will have to pay a higher cost for everything which has any kind of import content. Now, this is something which cannot be avoided, but at times it's possible that producers may take on a part of this burden. That is, what I mean is that they may not increase the final price to the full extent of the increase in their input costs. But there will be a partial transmission which takes place of a higher rupee cost of imports to the final price of goods. So that is something which we cannot escape and something which will be evident. Now, how serious is it? Our calculations are that it may not be more, say a 10% increase may lead to something like 0.4, 0.5% increase in the consumer price index, which means that the overall inflation rate could go up if there is 100% transmission of this 10% depreciation. So today, actually, the rupee is depreciated by around 5%, which means that around half of that 0.3, 0.4 maximum is something which would be transmitted to us as individuals.
Right. So, we know that whatever has a cost component in terms of dollars will have an impact. So your international travel to your iPhones. But I wanted to understand for my listener, is there a household cost that rises when the rupee turns volatile before people even notice that it's a currency issue? Is there a creeping cost?
No, the creeping cost may not really be there because the way in which the price transmission takes place is that it's not instantaneous. Because whoever is bearing the higher rupee cost, that is the importer or even the service provider. Let's look, for example, we want to buy an air ticket to the United States of America. Let's assume it was costing maybe 1 lakh rupees based on currency of, say, 88 rupees to a dollar. Now, let's assume that the rupee has gone from 88 to 90 rupees per dollar. The price of 1 lakh may not go up immediately, because there are different ways in which the airlines or the agencies which are dealing with these tickets operate. There will be quite a bit of hedging done. There will be a certain amount of averaging of the exchange rate which is done. So we may not really experience this immediately. So the important thing, Anirban, is that whether this exchange rate depreciation is sustained over a longer period of time, meaning thereby that is the depreciation of a durable variety. Now, for example, when the rupee went to 90, we all said 91, 92, but today we are at 89 something. So if it keeps moving in this manner, there may not be actually any significant transmission which takes place. But let's assume that we have a new normal of, say, 90 rupees to a dollar. That's the time when it really hurts, where your air tickets go up, your education costs, of course, is based and denominated in foreign currency, so that there will be an immediate transmission. But especially if you're looking at things like travel and tourism, it's unlikely that those kind of costs will really go up immediately.
Got it. One thing that has flummoxed a lot of rupee watchers is the sheer volatility. The fact that the central bank is sometimes almost allowing it to reach a certain level and hover there, and then suddenly, as if surprisingly, intervening. Now, the question is, when we talk of things like foreign travel or overseas education, is volatility worse than a steadily weaker rupee?
See, volatility is worse because there will be a lot of regret. When I say regret, for example, if I am financing, say, a course, and I'm buying the $1,000, say, today, and I'm paying 90 rupees to a dollar, and let's assume after 1 week it comes down to 89 or 88, then there will be this element of regret that, look, if only I held on for a week, then maybe I would have been better off. So volatility is something which hurts us more in case there is a definite depreciation and we know it's going down in a certain manner. Then I think there is less chance of regret. So I think when we are also talking in terms of the RBI intervention, the RBI always says we don't target a number, but we do monitor volatility. So they know very well that volatility is something which can upset the balance sheets of companies as well as the expenditures of individuals.
Got it. Now, let's talk about Mumbai's middle class. If it's spending more on cooking oil and pulses by, say, 8% due to import costs. But on the other hand, and this is a correlation many of us make, and you have to tell me whether it's a correct correlation or not. But when the RBI cuts rates, that translates to lower EMIs, and people think that this is sort of offsetting this kitchen inflation. Is that the right way to think about it?
See, it's not wrong, but it's not right too. Just remember, not everybody is a borrower in the market. So if people are there who are not really affected by interest rates, in fact, there would be a tendency for lower interest rates to affect people on the savings side. So I'll say that my real disposable income has come down because my interest rates have come down, and I'm still paying higher prices for products which are imported, like say edible oils or pulses, in which case I would be worse off. So that is the way one should be looking at it. If you're a borrower, you're probably better off. There's some kind of compensation. But if you're not a borrower, then definitely you tend to lose both ways.
Okay, now you've tracked import bills for so many years, I think 3 decades. With the rupee now at 92, if we talk about, say, a tier two manufacturer importing machinery, how should they time their purchase? Should they sort of pre-hedge now because it'll weaken even further, or wait for maybe the end of the year or beginning of next financial year? If the trade deal happens, then it might bounce, etc. What would you advise?
See, the ideal thing is that as a producer, if you're in the market, in the business of buying and selling goods, it's absolutely essential that one should hedge your forex risk. Now, what quantum of it is a choice which you'll have to, is a decision which you have to take based on what kind of exposures you have. But I think that is the only way out because in the current situation, like I, as an economist, may say that the ideal rate for the rupee should be 88.50 to 89.50, but things don't go in the ideal manner. We're seeing that there are different winds, different waves which are blowing, which is actually directing the rupee, lots of sentiments which are driving the rupee. So we're not really sure if the rupee is going to depreciate or it's going to appreciate. Because just mind you, the dollar is becoming weaker and ideally the rupee should get stronger. So if you're not getting stronger, something else is happening. So that is why I think the only solution is hedge your forex risk to the extent that it's possible.
Now, if interest rates do stay stable, can rupee volatility still affect EMIs and borrowing costs?
Look at it this way. When you're talking of AMIs, it's based purely in terms of what monetary policy does. Since all your lending rates for the retail sector are juxtaposed with benchmarks, which happens to be normally the repo rate. If the repo rate remains, say, at 5.25, maybe goes to 5 and stops at 5, your EMIs will end based on the repo rate because the interest rate will end at 5% or 5.25 plus whatever spread the bank is charging. That will have nothing to do with what is happening on the currency front in terms of your EMI payments. Of course, if the currency continues to depreciate, now it depends upon what you would do in terms of benchmarking. If I would say when I took a loan, say in 2020, I may be better off or worse off, then of course I can make a relative comparison. But if I do a comparison, say just in the current financial year, I think all the benefits in terms of AMIs would probably end once the repo rate cycle comes to an end. And then from that point of time, you will see that the rupee depreciation, which is more of a current phenomenon, will tend to dominate in terms of the net effect.
Understood. Now, let's come to education and jobs. Now, for the average Indian planning foreign education, say next year, their costs are already up 9.5%, according to what I read. Now, what should families do? Should they consider education loan in rupees and accept the forex risk? Or is this a time to really rethink or really prioritize on whether you really want to send your child to a foreign university? Maybe just abandon that thought altogether.
So let's assume it's $100,000 is the cost of a course, which when you multiply by, say, 85, it comes to a certain rate. And when it becomes 90, it obviously becomes more expensive. We should just think of it as saying that, okay, the cost of it, which earlier was, say, 1 crore, now goes up to 1 crore, 5 lakhs. That is the cost of it. So I don't think that should be the clinching argument when one is looking in terms of taking a decision about whether to have a foreign education or not. This said, of course, in terms of making provisions for payments, the interest which you will have to do in case you're borrowing, or if you're using your own funds, the amount which you will have to deploy will definitely increase. So I don't think it will be an argument, a clinching argument, that if a weaker rupee is going to stop people, this is going to go up. So probably you'll be expecting to get better rewards once this education is fulfilled and one is able to enter the job stream.
So, Madan, how worried should IT companies be about this volatility?
Yes, that will be a major issue because when you're planning for the future, what kind of income you're going to get, I think a volatile rupee will make things very much uncertain. So they will have to work on the basis of different scenarios, both in terms of what kind of revenue they're going to earn, as well as the kind of employment or the kind of headcount which they will have to maintain given the overall business conditions. Because finally, the Indian company will be reckoning things in rupees. And when we're talking in terms of a volatile rupee, this would be an issue. So, of course, we should remember that in case we're talking of sustained depreciation of the rupee, there will be a benefit for all earners, that is exporters, as well as the IT sector. So therefore, they could probably be working on the basis of earning higher revenue. But volatility definitely will be upsetting the plans, especially if it is for a longer period of time.
Got it. Now, there have been tremendous amount of FPI withdrawals. Talking about the investor, retail investor, will mutual funds, mutual fund SIPs be enough, you think, to stabilize the markets if volatility continues? Or are we headed for a broader sort of wealth erosion moment for the middle class in 2026?
No, I think in 26, the way we should look at it is that even in case the FPIs continue to be volatile, because we should remember one thing, that international markets are giving higher returns than what we're getting in India. Now, whether it's the FPIs which are causing it or whether it is the other markets which are doing better than the Indian stock indices is anyone's guess. But in this situation, what we have seen is that mutual funds appear to be the best option for a retail investor who wants to move away from the cozy confines of a bank deposit and move to the market. That is the best possible solution for the retail investor to go through mutual funds. Definitely investing directly in companies becomes a bit more trickier because you really don't know what is going to be the impact of rupee volatility in terms of depreciation or appreciation, and the kind of hedging strategies which companies have done, how much they are being affected on account of volatility in the rupee. That kind of knowledge is not something which is available to individuals, but definitely when we're talking in terms of mutual funds, where there is expertise in terms of who are doing the actual investing for you, I think that would be the best option for retail investors.
And what about the small saver? Does rupee volatility really change where their money should be parked?
So in terms of saving decision, I think they take it more on the basis of returns. So they will be comparing bank deposits all the time with what you get in the market. And depending upon your risk affinity, whether you're more risk prone, you're risk averse, or whether you're a risk taker, you will be taking a decision according to that. So I don't think the rupee volatility per se will be affecting the small investors' decision. To be more the return which you're getting, and they always go on the basis of what's happened in the most recent past.
Finally, Madan, 2 lines or more on how you think the rupee will behave in 2026.
No, I think the rupee will remain volatile until we have a deal with the US. And then, depending upon the content of the deal, it will be back to normal. As I told you, on the basis of two factors, that is, fundamentals of India's balance of payments, which is the inflows and outflows of dollars, appears to be fairly robust, I would say. Current account deficit is maybe ranging 1.5%, not an issue at all. Capital flows, and especially FPIs, that is something which has been irksome for us. But if you look at overall forex reserves of India, they have been increasing. So therefore, I think there is a lot of strength which is there. But we also need to look at what's happening to the dollar. As I told you, the dollar is weakening, likely to weaken further as the Fed keeps cutting rates, and the problems which we saw on account of the tariff in terms of higher inflation starts to bite the US, which we haven't seen so far. So therefore, the rupee should generally be stable once we have the deal, because I have a feeling it is the sentiment which is driving the rupee more than the fundamentals.
Madan, thank you so much for joining us.
Thanks.
Looking ahead to 2026, the rupee's fate hinges on one critical factor: the US-India trade deal. Economists predict the currency could slide to 85.5 by the end of the financial year and potentially toward 86 to 86.50 by December 2025. However, some analysts suggest a median forecast of around 88.91 by February 2026 if trade tensions ease. As Madan reminds us, India's fundamentals remain strong: robust forex reserves and manageable current account deficit. But in a world of Trump tariffs and Fed rate cuts, sentiment often trumps fundamentals. The key takeaway: hedge your forex risks where you can, diversify your investments through mutual funds, and remember that volatility is worse than a steady decline. The rupee story in 2026 will not just be written in Delhi and Bombay, but in Washington too. That's it for today. You were listening to this episode on The Morning Brief. It was produced by me, sound designed by Radhas Naik. A new episode of The Morning Brief drops every Tuesday, Thursday and Friday wherever you get your podcasts. Also, please listen to ET in the Valley every Wednesday and Corner Office Conversation on Mondays. Thank you.